2025 feels like the stock market's playing hopscotch on a trampoline. One week it's soaring, the next it's gasping for air. If you're wondering how to invest without losing your sanity, you're not alone. The trick? Build a lineup of ETFs. ETFs aren't boring anymore. They've become the backbone of everyday investors seeking steady growth and less drama. The financial world is like a noisy street market at rush hour. Each stall has its own sales pitch. AI is the future, buy now or regret forever. Gold is the only safe haven. The S&P 500, it's overpriced and soft. ETFs make the chaos manageable. They don't force you to bet everything on flashy salesmen, allowing you to sample the whole buffet. You can enjoy little portions of tech, a slice of gold, or a taste of healthcare without overcommitting to one. Gold ETFs are the old guardian of markets. Gold demands attention, being unpredictable at times, but dazzling when it shines. In chaotic times, gold struts down the aisle, reminding us of its strength through centuries of change. With global conflicts and inflation debates spiraling, gold remains a stable asset in tumultuous environments. Gold ETFs give you a way to capture timeless shine without filling your closet with bars and coins. They're always ready to play defense when the rest of your portfolio is melting down. Gold doesn't care about your timeline. It's indifferent to hype, scandals, and market fluctuations. That's why central banks hoard gold, even while preaching confidence in currencies. For regular investors, gold ETFs are the simplest way to tap into that ancient trust. You're plugged into history, seamlessly integrating gold into your modern portfolio. Gold ETFs are the ballast that keeps your ship from capsizing during market swings. Playing defense is important, but at some point, you need offense too. You need growth, something with energy, with ambition. The Apples, the Microsofts, the Nvidias, the names that don't just sell products, they shape entire industries. Owning them through an ETF tied to the NASDAQ 100 has felt like riding a rocket ship strapped to your portfolio. Beyond the skyscrapers of Wall Street are the smaller buildings, the scrappy innovators you've barely heard of. Small-cap ETFs scoop up those dreamers, bundle them together, and give you a chance to own an entire neighborhood of potential. It's high risk, yes, but when it pays off, it's the kind of reward that makes you remember why you invested. Playing defense is important, but at some point, you need offense too. You need growth, something with energy, with ambition. The Apples, the Microsofts, the Nvidias, the names that don't just sell products, they shape entire industries. Owning them through an ETF tied to the NASDAQ 100 has felt like riding a rocket ship strapped to your portfolio. Beyond the skyscrapers of Wall Street are the smaller buildings, the scrappy innovators you've barely heard of. Small-cap ETFs scoop up those dreamers, bundle them together, and give you a chance to own an entire neighborhood of potential. It's high risk, yes, but when it pays off, it's the kind of reward that makes you remember why you invested. You can't ignore batteries, clean energy, and how our world is shifting gears. Cars aren't just cars anymore. They've become rolling computers with wheels attached. Every year, the old combustion engine feels more like a relic, while EVs keep stealing headlines and road space. Power grids are being upgraded to store energy smarter, balance supply with demand, and cut reliance on fossil fuels. Thematic ETFs zoom in on storylines defining the next decade. Take a lithium and battery technology ETF, for instance. It's about companies mining lithium, designing batteries, and supplying raw materials for tomorrow's energy economy. You're investing in a world where oil pumps fade into history, and battery packs power cars, homes, factories, and cities. Now, growth like that is thrilling. It's the adrenaline rush of investing. But adrenaline isn't a long-term plan. Enter quality ETFs. These funds don't chase whatever's flashing in the headlines. They tilt toward companies with strong balance sheets. Think of them as the responsible adults in a room full of excitable teenagers. Quality ETFs invest in businesses that survive recessions, shrug off political noise, and continue paying dividends. If growth is the gas pedal, quality is the brake system. Together, they allow you to steer without crashing. In a world where news headlines can shake entire markets, that balance isn't just smart, it's survival. 2025 has another obsession: AI. Every headline seems to sneak it in. Some of it's hype, but some of it is absolutely real. AI isn't just about ChatGPT spitting out poems. It's reshaping medicine, logistics, finance, and manufacturing. Ignore AI ETFs, and you risk missing one of the biggest shifts since the internet itself. If you pile everything into hype, you're basically gambling. Balance is key. ETFs are your ingredients: gold for safety, growth for ambition, quality for stability, fiends for a spark. Let's not forget about the quiet backbone, the broad, low-cost ETFs that simply track the market. They're the steady beat beneath the music. Owning an ETF tied to the S&P 500 or total international market is like having a foundation under your house. Without it, everything else crumbles. Before 2026, those broad ETFs remain the anchors. You need stability underneath. Maybe you're cautious and want a portfolio heavy on gold and quality, or young and bold with growth and AI. No single right lineup exists. It's about positioning yourself for the next decade. The world's changing fast. ETFs help you stay in the game. They're like a seatbelt in a race car, letting you accelerate while still keeping you safe. When you look back in 2030, will you wish you'd built a portfolio of ETFs or sat on the sidelines as inflation took its toll? ETFs are just investments. They're characters in your financial narrative. Gold, the guardian. Growth, the dreamer. Quality, the steady hand. AI, the wild child. Broad market ETFs are the backbone, holding it all together. Get that cast right, and your story becomes one worth telling. Investing is about writing a story you'll be proud of, one where you moved forward with balance, curiosity, and boldness. Before 2026 hits, build your story, add your characters, make it personal. The worst move isn't picking the wrong ETF, it's not picking any at all. If this deep dive got you thinking, hit that like button, drop a comment with the ETFs you're watching, and subscribe for the next chapter. The Roth IRA is one of the most powerful money machines available. You put in after-tax dollars, it grows tax-free. When you take the money out decades later, you owe the IRS absolutely nothing. Zero, zilch, nada. Choosing the right investments inside your Roth IRA is crucial. You want high-quality ETFs that can grow and pay you dividends over time. Today, we're discussing 6 ETFs that could potentially make you wealthy in a Roth IRA. These aren't magic lottery tickets. They are smart, proven, diversified investments. Left alone to compound for years, these investments can quietly turn into a 7-figure fortune. If you want one ETF that can essentially run your entire Roth IRA for decades, it's VTI. This fund buys the entire US stock market in one shot. You're spreading your investment across more than 4,000 companies, from big names like Apple to tiny regional banks you've never heard of. The US stock market averages about 10% annual returns over the long term, potentially doubling your money roughly every 7 years. Inside a Roth IRA, that doubling effect is even sweeter, as you never pay taxes on growth. Max out your Roth each year and let it ride. With VTI's expense ratio at just 0.03%, you're paying $3 per year on every $10,000 invested. Find another service at that price. VTI is the definition of set it and forget it. You own all the stocks without any guesswork. As winners carry the market higher, VTI is a cornerstone for investors seeking simplicity, diversification, and long-term wealth. Now, let's zoom in a little. Instead of owning the entire market, VU focuses on the creme de la creme, the 500 largest companies in America. Owning it directly through VU is such a smart move. You'll be invested in names like Apple, Microsoft, and Amazon. These aren't just companies, they're economic juggernauts, representing about 80% of the US stock market's total value. Historically, $10,000 invested in the S&P 500 grew into well over $2 million. That's not a typo. $2 million. The cost is ridiculously low, too. Like VTI, VU only charges 0.03% in expenses. In a Roth IRA, that growth isn't just compounding, it's compounding tax-free. Growth is great, but steady paychecks are better. That's where VIG shines. It only buys companies that have raised dividends for at least 10 years. Think of names like Johnson & Johnson, Procter & Gamble, and PepsiCo. They're reliable, cash-rich companies that keep paying investors. The yield on VIG is usually around 2%, but it excels in growth. Annual dividend increases lead to significant compound growth. In a Roth IRA, you keep all dividends tax-free. This smart move allows your cash payouts to snowball without the IRS taking a portion. VIG provides steady income and long-term growth. It's like planting a fruit tree that yields bigger harvests yearly, tax-free. If VIG is the gardener, SCHD is the powerhouse. It screens for companies with high yields and strong cash flows. CHD usually yields 3 to 4%, meaning $3,000 to $4,000 in annual dividends from a $100,000 investment, all tax-free in a Roth IRA. The fund includes companies like Coca-Cola and Verizon, known for their durability in any economy, making SCHD appealing for long-term investing. SECT's dividend tends to rise, effectively giving you a raise each year, ideal for retirees and younger investors alike. CHD is a fan favorite, delivering income and growth at a low cost. It's essential for future Roth IRA income. The Vanguard Information Technology ETF is all about tech, the sector that has been minting fortunes for investors for decades. Owning VGT means having a collection of the biggest tech names, Apple, Microsoft, Nvidia, and more. Tech is more volatile than other sectors. VGT can shoot up 25 to 30% some years and tumble 20% in others. Over the long haul, VGT has outperformed the S&P 500, due to technology's fast-paced growth. Roth IRA is perfect for VGT. You can ride out short-term dips while enjoying long-term tax-free growth. Adding VGT to your Roth IRA is like stepping on the gas pedal. It brings higher risk, but the potential for outsized rewards. It's easy to think the American market is the only one that matters, but there are huge companies all over the world. ACWX gives you exposure to more than 2,000 international stocks. We're talking about Nestlé in Switzerland, Samsung in South Korea, Toyota in Japan, and Tencent in China. They're leaders in their industries and dominate globally. Some decades the US leads, but other decades international markets pull ahead. Diversifying globally reduces risk and captures growth potential. International funds can get complex due to foreign taxes, but in a Roth IRA, you sidestep much of that complexity. Your investments compound cleanly. ACWX adds resilience to your portfolio. It isn't about being flashy, but smoothing out returns and maximizing your chances of wealth. The secret is consistency. Max out your Roth IRA, invest in these ETFs, and let compounding work for you.
Tax season isn't just about scrambling for receipts and dreading that final number. This year, what if tax season became the moment you quietly set yourself up for a tax-free, seven-figure retirement using just a handful of powerful ETFs inside your Roth IRA? Think about it. While most people are stressing about what they owe, you could be locking in contributions that your future self will withdraw completely tax-free. No capital gains tax, no tax on dividends, no tax on growth. If your money is going to work hard, your Roth IRA is where you want your highest performers, your best, most aggressive growth ETFs doing the heavy lifting. Here's the mindset shift. Your Roth IRA is not a savings account. It's your personal government-approved tax shelter for long-term, high-growth investments. You already paid tax on the income going in. That means the IRS doesn't get a second bite when that money doubles, triples, or 10 times as. So instead of filling it with safe bonds or cash-like funds, this is where you want to place the long-term rockets. Broad market growth ETFs and focused growth funds that benefit from decades of compounding. Now, before diving into specific ETFs, one core principle. Your Roth IRA is a long-term game. Think 20, 30, even 40 years. That long runway is exactly why growth-focused ETFs make sense here. Yes, they're volatile. Yes, they can drop 20 to 30% in bad years. But over decades, that volatility becomes noise, and the trend is what matters. And if that trend plays out inside a tax-free container, that's where serious wealth is built. Let's put numbers on it. Imagine you invest $7,000 into a Roth IRA this year and choose a growth ETF averaging 10 to 12% annually over the long run. At 10%, that one contribution becomes about $49,000 in 30 years. At 12%, it's closer to $70,000. Now imagine doing that every year, stacking contributions with smart ETF choices. You're not just investing, you're building a tax-free money machine. So what kind of ETFs deserve a spot on that tax-free pedestal? Start with a broad U.S. total market or large cap growth ETF as your core. These funds spread your risk across hundreds of companies, giants like Apple, Microsoft, and Amazon, plus emerging winners you may never have heard of. Instead of betting on one stock to be the next big thing, you ride the entire wave of American innovation. A total market or large cap growth ETF is like owning a slice of the entire U.S. economic engine, and in a Roth, all that growth belongs to you and you alone. Layered on top of that, you want a dedicated growth ETF, something focused on companies with high earnings growth, strong reinvestment, and long runways. These ETFs tend to tilt heavily toward tech, consumer innovation, and healthcare disruptors. They might be more volatile than a total market fund, but over a long horizon, they can push your average returns higher. The Roth structure absorbs that volatility beautifully because you're not trying to trade in and out. you're buying and holding. Then comes the tech-heavy or NASDAQ-style ETF. This is your turbocharger. These funds concentrate heavily in technology, communication services, and growth leaders. AI, cloud computing, semiconductors, software, they can be the most aggressive part of your Roth portfolio. The downside? Big swings. The upside? Some of the strongest long-term returns in the market. Held in a taxable account, actively trading these could generate painful capital gains taxes. Held in a Roth for 15 to 20 years, it's raw, untaxed growth. To balance that, consider adding a small cap or small cap value ETF. Small caps are the scrappy up-and-comers, businesses earlier on their growth curve. Historically, small cap stocks have often outperformed large caps over long periods, but with more volatility. Putting a slice, say 10 to 20% of your Roth IRA into a small cap or small cap value ETF can add extra fuel. The dividends and gains from these more volatile names are exactly the kind of thing you want shielded from tax. You can then sprinkle in international exposure using a broad international or total ex-US ETF. This brings in Europe, Japan, emerging markets, and other regions. Why bother if US growth is so strong? Diversification. Sometimes international markets outperform US markets over multi-year stretches. Having 10 to 20% of your Roth in a low-cost international ETF spreads your bets beyond one country. And again, foreign dividends and currency-driven gains are simpler to deal with inside a tax-free wrapper. Now let's talk about what makes ETFs themselves tax efficient and why that matters, even inside a Roth. ETFs use a creation/redemption mechanism that lets them shuffle underlying holdings without triggering as many capital gains as traditional mutual funds. In a taxable account, that means lower annual tax bills. In a Roth, it means your fund isn't constantly realizing gains behind the scenes. It's quietly compounding. You're stacking an already tax-efficient vehicle inside a tax-free container. It's like double insulation. But there's another angle. Growth ETFs usually pay relatively low dividends compared to high-yield or bond funds. In a taxable account, dividends are taxable every year. In a Roth, you don't care. But by combining low dividend payouts with high reinvestment, growth ETFs essentially reinvest earnings inside the companies, boosting share prices instead of constantly distributing cash. That price appreciation is the kind of thing you want locked inside a Roth forever. So how do you actually put this together inside a Roth IRA in 2025? Imagine a simple yet powerful allocation for a long-term investor. 40% in a US total market or large cap growth ETF minus 25% in a pure growth ETF tilted toward fast growers. Minus 15% in a tech-heavy or NASDAQ-style ETF. Minus 10% in a small cap or small cap value ETF. Minus 10% in an international ETF. This mix gives you broad coverage, strong growth tilt, global reach, and exposure to both giants and small challengers. You get diversification without watering down your growth potential. If you're more conservative, you can increase the total market portion and reduce the pure tech and small cap slices. If you're younger and more aggressive, you can tilt more heavily toward growth and tech. But here's the key. That allocation is not some rigid rule carved in stone. It's a starting framework you can bend around your real life. If you're in your early or mid-20s, you might lean even harder into growth and tech because your biggest asset isn't money, it's time. You can afford to ride out gut-wrenching drops because you've got 30 or 40 years of compounding ahead of you. In that case, maybe your mix looks more like 30% total market, 35% growth, 20% tech, 10% small cap, and 5% international. More aggressive, more volatile, but with more upside baked in. On the other hand, if you're in your late 40s or early 50s, with retirement starting to peak over the horizon, you might dial things back a notch. You still want growth, this is a Roth after all, but you probably don't want your entire portfolio swinging 30% in a single year. For you, a calmer version might be 50% total market, 20% growth, 10% tech, 10% small cap, 10% international. Same building blocks, just shifted slightly towards stability while still taking advantage of tax-free growth. Another angle most people ignore. Your Roth IRA does not exist in a vacuum. You have 401s, Ks, maybe a taxable brokerage account, maybe even an HSA. You can think of all of these buckets together as your master portfolio, then decide which assets belong where. For example, if your 401k is stuffed with a target date fund that's already heavy on bonds, you might choose to make your Roth the pure growth engine that tilts harder into equities. That way, across all accounts, you're balanced. But the Roth is still doing the heavy lifting on the growth side. This is also where tax location strategy quietly makes you look like a genius in 20 years. The general rule of thumb: put your most tax inefficient, highest upside stuff in the accounts with the best tax treatment. High yield bonds, or REITs, which spit off a lot of taxable income, fit well in tax advantaged accounts. Fast growing, high turnover strategies, also better sheltered. Low turnover, hyper-tax efficient funds like broad index ETFs can sit safely in taxable accounts if needed, so when you're choosing what goes into your Roth, ask, which of my investments will hurt the most in a taxable account? Those are your Roth candidates. One more thing that almost no one talks about: behavior. Picking ETFs is the easy part. Sticking with them when the market is down 25% and headlines are screaming, "This time is different," is the real test. Your Roth IRA should be built in a way that you can emotionally handle. If you know that seeing a 40% drawdown will make you sell at the bottom, building a hyper-aggressive portfolio you can't stomach is actually worse than choosing something slightly less optimal on paper. Sometimes the best Roth IRA portfolio is the one you can sleep with at night and stick with for decades. So as you look at those percentages, 40% here, 25% there, don't just think in terms of numbers. Think in terms of your own psychology, your age, your income stability, and your other accounts. The goal isn't to build the mathematically perfect portfolio. The goal is to build a Roth setup that fits your reality, harnesses long-term growth, and lets tax-free compounding quietly do its thing in the background while you live your life. Now, strategy: how and when you contribute matters. One powerful move is to contribute as early in the tax year as possible. Tax law allows you to contribute for a tax year up to the filing deadline, but the earlier your money is invested, the more time it has to compound. Putting $7,000 in January instead of next April gives you 15 extra months of potential market exposure. Over decades, those early contributions can make a surprising difference. If dropping a lump sum feels scary, automatic monthly contributions are your friend. Set up $500 or $600 a month going straight into your Roth and into your chosen ETFs. That's dollar cost averaging. You're buying shares in up and down markets, smoothing out your entry price. Instead of trying to time the market and probably getting it wrong, you let time in the market work for you. Rebalancing is another key Roth strategy. Over time, your tech or growth funds might outpace everything else and swell to a bigger portion of your portfolio. Once a year, take a look at your percentages. If your plan was 40, 25, 15, 10, 10, but now tech has ballooned to 25%, you can sell a bit of that ETF and buy more of your lagging areas. In a taxable account, that might trigger gains and a tax bill. Inside a Roth, you can rebalance freely. No tax consequences, no penalty, just realigning to your long-term plan. Contribution limits also matter. For 2025, you're capped at the annual Roth limit, plus catch-up if you're over 50. The key is, don't leave that space empty. Every year you don't use your Roth room is a year of tax-free growth you can never get back. Think of your Roth contribution like an expiring ticket. Once that year is gone, the unused space disappears. If your income is too high to contribute directly to a Roth, strategies like the backdoor Roth may apply, contributing to a traditional IRA and then converting to a Roth, following the rules carefully. That's something to research or discuss with a professional, but the end game is the same. Get money into that Roth shell, then fill it with the best long-term growth ETFs you can find. Another subtle but powerful point: your Roth is a great place to hold the least tax-friendly assets. For example, growth ETFs that might produce occasional large gains, or strategies that tilt towards smaller, more volatile names. Assets you want to trade or rebalance more frequently belong in Roth first, taxable last. Meanwhile, ultra tax-efficient broad index funds can sit in a taxable account without causing too much yearly tax drag. Now imagine yourself at 55 or 60 looking back. You've contributed regularly through bull markets and bear markets. You ignored panic headlines, kept buying the same low-cost growth ETFs, and rebalanced annually. Your Roth IRA isn't just a line item. It's the engine that's going to fund your travel, your hobbies, and your freedom without the fear of surprise tax bombs. Maybe you started with $3,000 in your first year and gradually worked up to the max. Maybe you began late but cranked up contributions aggressively. Either way, the combination of a Roth structure plus growth-focused ETFs works quietly in the background. You're free to choose when and how you withdraw, without worrying about pushing yourself into a higher tax bracket in retirement. And that's the real magic here: flexibility. Traditional retirement accounts are fantastic for tax deferral, but every withdrawal in retirement gets taxed as ordinary income. With a Roth, qualified withdrawals don't touch your tax bracket. That gives you the flexibility to control how much taxable income you recognize from other sources: Social Security, pensions, rentals, part-time work, while using your Roth as a tax-free buffer. So when you think tax season, don't just think refund or bill, think reset. This is the moment each year where you get to decide, am I going to let my Roth sit underused, or am I going to load it with the best long-term growth assets I can find? Am I going to treat this like a side thought or like the core of my future financial freedom? Here's the simple blueprint you can follow starting this tax season. Decide your target allocation between total market, growth, tech, small cap, and international. Open or fund your Roth IRA at a low-cost broker. Set automatic monthly contributions so you don't rely on willpower. Buy your chosen ETFs consistently according to your plan. Review once a year, rebalance, and resist the urge to tinker every week. Tax season is when most people look backward at what they earned, what they spent, what they owe. Use it to look forward. Use it to build something that your future self will thank you for when the numbers on the screen don't just represent investments, but freedom. Because when you combine a Roth IRA with the right growth-focused ETFs, you're not just trying to save for retirement. You're quietly building a tax-free empire in the background of your life, one contribution, one ETF, and one tax season at a time. Take 30 seconds now. Save this, review your portfolio, and level up your tax-free future. Tap like, drop a comment, and share this video with a friend who still hasn't fixed their Roth IRA. Hit subscribe and turn on the bell so you never miss the best 2025 ETF ideas.
Every time someone mentions ETFs that can make you rich, the same ticker pops up: SCHD. But today, I want to step away from the usual suspects. If you're like me, you want growth, opportunity, and maybe a little excitement in your portfolio heading into 2025. Here are 5 ETFs that I believe could change the game for investors this year. And no, SCHD isn't on the list. ETFs provide a unique blend of diversification and dynamic growth potential. Let's dive into these exciting options. Ready to discover these transformative ETFs? Get your portfolio ready for a refreshing change. I've got to start with QQQ. You're probably thinking, is QQQ already one of the most popular ETFs? Yes, that's the point. QQQ gives you exposure to the NASDAQ 100, which means you're buying into the backbone of tech innovation. Companies like Apple, Microsoft, Amazon, Nvidia, and Meta are shaping both the stock market and our daily lives. QQQ has consistently outperformed the S&P 500 over the past decade, especially with tech innovations booming. It offers more upside potential, although it's more volatile than broad market ETFs like VU or SPY. QQQ is heavily traded, offering liquidity, tight spreads, and transparency. I can sleep at night knowing exactly what I own. If you want growth in 2025, QQQ is practically a cheat code. If QQQ is the all-star team, VGT is like doubling down on the MVPs. It's Vanguard's information technology ETF, focused purely on tech. VGT trims the fat and goes straight for pure technology. Think Apple, Microsoft, Visa, Broadcom, and NVIDIA. Tech isn't just a sector anymore. It's the foundation of every other sector. Finance, healthcare, retail, and even your car rely on tech. As demand for semiconductors, cloud infrastructure, and digital payments grows, so does the upside for VGT's companies. VGT naturally tilts toward innovation, adjusting with market cap weighting. I ride the wave of the strongest performers. VGT is concentrated and can be volatile. If I believe in AI, cloud computing, and digital transformation, I want maximum exposure. With a low expense ratio of just 0.10%, VGT is a growth accelerator. Not for comfort, but for conviction. Okay, let's switch gears for a second. Because it's not just tech that's going to define 2025. It's energy, and more specifically, clean energy. This ETF gives you exposure to a basket of global clean energy companies, covering everything from solar and wind to hydro and storage. Governments are tightening climate targets, pouring money into green infrastructure, and subsidizing renewable adoption at scale. Even big oil companies are diverting billions into renewables. Clean energy isn't a fad, it's the inevitable future. ICLN gives me exposure to major clean energy leaders like Enphase Energy, Vestas Wind Systems, and Plug Power. Clean energy stocks are volatile, but I see that volatility as opportunity. Pullbacks are just hidden entry points. With climate policy heating up for 2025, I think ETFs like ICLN could be poised for a breakout year. VNQ, the Vanguard Real Estate ETF. Real estate is quietly building wealth the old-fashioned way, through income and stability. VNQ invests in REITs, buying into companies that own and operate properties like office buildings and warehouses. These REITs have to return at least 90% of their taxable income to shareholders as dividends. Steady cash flow, even in choppy markets. Why 2025? REITs are set for a rebound. Interest rates stabilize, inflation cools, and valuations adjust. VNQ could capture appreciation and keep delivering those juicy yields at the same time. Real estate isn't what it used to be. It's not just about malls and office towers anymore. VNQ gives me exposure to modern infrastructure, logistics centers, healthcare facilities, cell towers, and data centers. These aren't just buildings. They're critical assets in a digital-first world. VNQ isn't going to shoot up like NVIDIA after an AI boom. It's not built for explosive returns. I own VNQ because it's ballast, balancing my portfolio with income-producing assets that historically beat inflation. Real estate might not sound flashy, but VNQ quietly builds your wealth in the background. Slow, steady, reliable. Now, I know this one's controversial. Cathie Wood's flagship ETF has had some insane highs and some brutal lows. Disruption never moves in a straight line. It's messy, it's unpredictable, and that's exactly why ARKK is so fascinating heading into 2025. We're talking genomics, fintech, artificial intelligence, robotics, and next-gen internet. Inside the fund, you'll find names like Tesla, Roku, Block, Coinbase, and a whole list of companies that split investors right down the middle. If just a few of these bets play out the way Cathie Wood envisions, the payoff could be massive. RK is volatile, no doubt about it. It's the kind of ETF that can fall 10% in a week and then rally 20% the next. If even 2 or 3 of these themes really catch fire, ARK stands to benefit in a big way. I don't put my life savings into ARK-K. That would be reckless. But as a satellite position, it's worth it. You need that moonshot exposure, that slice of your investments with potential to explode. RKK offers asymmetric upside. It's about whether 1 or 2 companies become giants. If that happens, the payoff outweighs the volatility. Here are my 5 ETFs for 2025: QQQ, VGT, ICLN, VNQ, and ARK. Each has its own risk and flavor. Pick the ones that match your risk tolerance, timeline, and conviction. Wealth is built on strategy and patience. If you got value from this, make sure to like, subscribe, and comment. Which ETF are you most bullish on for 2025?